Good day Forex trader. Euro USD to extend its rebound on a break past 1.06. Despite the intense flight to safety on Monday, Euro USD managed to stay resilient. As Street's Aaron Sengezer notes, bulls could show interest on a move above 1.06. Euro USD could extend its recovery with a 4-hour close above 1.06. In case safe haven flows dominate the markets during the American session, Euro USD could find it difficult to gather bullish momentum. On the upside, 1.06, psychological level, Fibonacci 23.6% retracement of the latest downtrend, forms the first resistance. With a 4-hour close above that level, the pair could extend its rebound toward 1.0640, 100-period SMA, and 1.0660, Fibonacci 38.2% retracement. A 4-hour close below 1.0540, 20-period SMA, 50-period SMA, could be seen as a bearish development and open the door for additional losses toward 1.05, psychological level, and 1.0470, multi-year low set on April 26. GBP USD Forex signal, sterling next support at 1.2200. The pair will likely keep falling since it has formed a break and retest pattern by retesting the resistance at 1.2414. Bearish view. Set a sell stop at 1.2300 and set a take profit at 1.2200. Add a stop loss at 1.2400. Timeline, 1 to 2 days. Bullish view. Set a buy stop at 1.2415 and a take profit at 1.2500. Add a stop loss at 1.2350. The GBP USD pair attempted to crawl back during the American session as the US dollar continued strengthening. The pair rose to a high of 1.2347, which is about 0.68% above Monday's low of 1.2268. This level was the lowest level in more than 2 years. Sterling downtrend continues. The GBP USD pair has been in a strong bearish downward trend in the past few days as investors worry about the health of the UK economy and the strong US dollar. Recent data show that the UK economy is struggling as inflation rise. For example, recent data showed that the economy barely grew in the first quarter of the year. Inflation has also soared to the highest level in years while real earnings have moved to the negative level. There are also worries that the overheating housing sector could see diminishing demand as interest rates rise. The main challenge for the UK mortgage market is that it is increasingly short-term, unlike other countries like the US and Germany. Most people in the UK prefer mortgage periods of less than 5 years, meaning that the situation could worsen in the coming months as rates rise. The GBP USD pair has also declined because of the rising US dollar. The dollar index has risen to the highest level since 2002 as investors continue reflecting on the hawkish Federal Reserve. The bank announced that it will continue hiking interest rates in the coming months. While the Bank of England implemented its fourth interest rate hike since December, the governor warned that the country will likely go through a recession in the coming year. With no data scheduled from the US and the UK, investors will continue focusing on the upcoming US inflation data. The numbers will provide signs about whether inflation has peaked after soaring to the highest point in over 40 years. GBP USD forecast. The GBP USD pair has been in a strong bearish trend in the past few months. On the 4-hour chart, the pair has moved below the 25-day and 50-day moving averages. It has also moved slightly below the important support level at 1.2415, which was the lowest level since April 28. Therefore, the pair will likely keep falling since it has formed a break and retest pattern by retesting the resistance at 1.2414. Therefore, the pair could soon drop to 1.2200. AUD USD Forex signal, rebounding from 18-month low. The 0.6926 is holding as support. Today's AUD USD signals. Risk 0.75%. Trades must be taken before 5 p.m. Tokyo time Wednesday. Short trade ideas. Short entry following a bearish price action reversal on the H1 time frame immediately upon the next touch of 0.6996, 0.7030 or 0.7059. Put the stop loss 1 pip above the local swing high. Adjust the stop loss to break even once the trade is 20 pips in profit. Take off 50% of the position as profit when the price reaches 20 pips in profit and leave the remainder of the position to run. Long trade ideas. Long entry following a bullish price action reversal on the H1 time frame immediately upon the next touch of 0.6926 or 0.6885. Put the stop loss 1 pip below the local swing low. Adjust the stop loss to break even once the trade is 20 pips in profit. Take off 50% of the position as profit when the price reaches 20 pips in profit and leave the remainder of the position to run. The best method to identify a classic price action reversal is for an hourly candle to close, such as a pin bar, a doji, an outside or even just an engulfing candle with a higher close. You can exploit these levels or zones by watching the price action that occurs at the given levels. AUD-USD analysis. I wrote in my previous piece on this currency pair on May 3 that it seemed clear that the support level at 0.7082 was going to be the day's pivotal point. I thought that if 0.7082 held as support, we would probably see the price rise over the short term. This was the good call and could have been used as the basis for a profitable day or swing trade. The price has moved quite strongly lower over the past week, as risk-off sentiment accelerates, and the US dollar continues to advance to new long-term highs. The Australian dollar tends to function as a risk barometer, falling when risk-off sentiment increases. Yesterday's strong risk-off move pushed the price down to a long-term low not seen in 18 months below the key support level at 0.6926. However, the price has rebounded from there in recent hours. Despite this rebound, there is still a lot of bearish weight likely here, and I see the next key development to watch for now as whether the big round number at 0.7000 will hold as resistance, or will the price get established above it. The 0.7000 level could be a very attractive area for new short trades to enter the market. I will be happy to enter a short trade from a bearish reversal at 0.6996, especially if 0.7000 is rejected. I will still take short setups from the two higher resistance levels identified above, but with less confidence and so a smaller position size. USD TRY wakes up and climbs to fresh 2022 highs beyond 15.00. USD TRY sees its upside renewed and climbs above 15.00. Turkey unemployment rate rose to 11.5% in March. Turkey 10Y bond yields rose to multi-week highs past 23%. Finally, some action around the pair. The Turkish lira remains on the back footing and motivates USD/TRY to clinch fresh 2022 highs past the 15.00 mark on Tuesday. USD TRY in 5-month highs. USD TRY posts gains for the fourth consecutive session, this time surpassing the key barrier at the 15.00 yardstick for the first time since mid-December 2021. Indeed, the lira loses further ground despite the broad-based improvement in the risk complex and the offered stance in the US dollar, while Turkey 10Y bond yields rose to multi-week highs north of the 23% mark. In what was the sole release in the domestic calendar, Turkey's jobless rate edged higher to 11.5% in March. Later in the session, and absent relevant releases in the US docket, the dollar is expected to take center stage in light of speeches by FOMC's Williams, Bostic, Waller, Kashkari, and Mester. What to look for around TRY? The lira broke below the multi-week range-bound theme versus the greenback and lifted USD TRY to the area beyond the 15.00 neighborhood. So far, price action in the Turkish currency is expected to gyrate around the performance of energy prices, the broad risk appetite trends, the Fed's rate path and the developments from the war in Ukraine. Extra risks facing TRY also come from the domestic backyard, as inflation gives no signs of abating, real interest rates remain entrenched in negative figures and the political pressure to keep the CBRT bias towards low interest rates remain omnipresent. Key events in Turkey this week: unemployment rate, Tuesday. Eminent issues on the back boiler, FX intervention by the CBRT. Progress, or lack of it, of the government's new scheme oriented to support the lira via protected time deposits. Constant government pressure on the CBRT versus banks' credibility/independence. Bouts of geopolitical concerns. Structural reforms. Upcoming presidential/parliamentary elections. USD tri-key levels. So far, the pair is gaining 1.14% at 15.2430 and faces the next hurdle at 15.2445, 2022 high May 10, seconded by 18.2582, all-time high December 20, and then 19.00, round level. On the other hand, a drop below 14.6836, monthly low May 4, would expose 14.5458, monthly low April 12, and finally 14.5136, weekly low March 29. USD JPY price analysis, stuck in a range above 2-week-old ascending trend line. USD JPY oscillated in a range through the first half of the European session on Tuesday. The mixed technical picture held back traders from placing aggressive directional bets. Investors also seemed to wait for the latest U.S. consumer inflation figures on Wednesday. The USD-JPY pair lacked any firm direction on Tuesday and seesaw between tepid gains/minor losses through the first half of the European session. The pair was last seen trading around the 130.15 region, nearly unchanged for the day. The ongoing retracement slide in the U.S. Treasury bond yields kept the U.S. dollar bulls on the defensive and acted as a headwind for spot prices. That said, the risk-on impulse undermined the safe haven Japanese yen and extended some support to the USD-JPY pair. Looking at the broader picture, the overnight pullback from a fresh two-decade high, around the 131.35 region, constitutes the formation of a bearish double-top pattern on short-term charts. The corrective slide, however, stalled near a 2-week-old ascending trend line. Support, currently around the 129.75 to 129.70 region, coincides with the daily low and should act as a pivotal point for intraday traders. A convincing break below would suggest that the USD/JPY pair has formed a near-term top and pave the way for further losses. Spot prices could then accelerate the fall towards testing the 100-period SMA on the 4-hour chart, around the 129.00 round figure. The downward trajectory could further get extended towards the 128.25 to 128.20 region en route the 128.00 mark and the 127.70 to 127.65 support. On the flip side, the 130.70 to 130.75 region now seems to act as an immediate resistance ahead of the 131.00 mark. Some follow-through buying should allow the USD-JPY pair to climb back to over a two-decade high, around the 131.35 region touched on Monday.